Most traders know the popular price oscillators, like the stochastic, the relative strength index, and so forth, but few traders know about or use volume oscillators, a far more important category. While price oscillators are used mostly to reveal overbought and oversold price conditions with a high and low percentage range, volume oscillators can help identify the energy behind the move. Volume oscillators can expose market energy of all kinds, as well as reveal the shift of energy from up to down and vice versa. Being able to identify an increase in volume or a shift in direction can help the short-term trader determine the duration and sustainability of the current price action. This can also help screen out weaker stock picks and ascertain when to exit a trade. In today's institutional activity-based market, the volume oscillator can reveal buying and selling patterns before price begins a major move. This is because many of the large institutions are careful not to disturb price as they buy incrementally. The standard volume oscillator available for most charting software is a centerline oscillator. Instead of oscillating between a high range and a low range the way most price oscillators do, centerline volume oscillators move above and below a zero line. The centerline exposes the volume energy behind the price action for both buy and sell sides. The volume oscillator consists of two moving averages of volume, one fast and one slow. The fast volume moving average is then subtracted from the slow moving average. If the fast moving average is above the slow moving average, the oscillator will be positive. If the fast moving average is below the slow moving average, then the oscillator will be negative. By watching the volume oscillator, you can take your projections to a more analytical level to anticipate price changes before price reverses on the short-term trend. And being able to anticipate price action well ahead of the event is an advantage when the market is moving with velocity. So how and when to use it? There are numerous ways you can use the volume oscillator to speed up your trade analysis. The volume oscillator is easy to read because of its centerline. As the volume indicator moves up above the centerline, it indicates accumulation or rising interest in the stock to the buy side. As long as the indicator remains above and/or oscillating near the centerline, buyers will dominate stock activity, and the bias will remain to the upside on the short-term trend. When the volume oscillator heads down and moves well below the centerline, a distribution or selling pattern is occurring. For short-term trading, this can be profit-taking after a big up move. A positive value suggests enough market support exists to continue driving price activity in the direction of the current trend. A negative value suggests a lack of support, indicating that prices may become stagnant or reverse. An increase or decrease in price, fueled by an increase in volume, may be considered a sign of strength in the prevailing trend. Therefore, when the fast-moving average, the default 14 period, is above the slow-moving average, the default 28 period, the volume oscillator is above the zero line and may be confirming price direction, whether it will be up or down. An increase or decrease in price, fueled by a decrease in volume, may be considered a sign of weakness in the prevailing trend. Therefore, when the fast-moving average is below the slow-moving average, the volume oscillator is below the zero line and may be a warning that the price direction is lacking strength and conviction. In this chart, the fact that the price is making higher highs and higher lows might be viewed by many traders as a bullish sign. When the price increase is combined with the volume oscillator making higher highs and higher lows, a trader may consider this to be even more bullish. On this daily chart example, as price moves up during this period, the volume oscillator pattern forms lower highs, indicating a weakening of upside energy. So when the price was increasing, the volume oscillator was not confirming the price movement, because it was decreasing, making repeated lower highs and lower lows. This bearish divergence indicated that the recent price increases were not being made with volume strength. By studying these patterns carefully, you can anticipate and prepare for reversals and retracements prior to the price actually changing. For this reason, the volume oscillator is a great confirmation indicator. You can use it to confirm a breakout of support or resistance. For example, a breakout of resistance, which goes hand in hand with an increase in volume, indicates a strong move. This is a great way to spot false breakouts also. In this second example, we have a breakout to the downside. Notice how the price approaches the previous swing low, and the volume oscillator spikes higher. The way you should read this is that the amount of selling pressure increased on the retest of the second low. However, the volume oscillator will provide a ton of false signals when the market is in tight ranges. The price and volume action will look non-existent, yet the oscillator could be moving above and below the zero line. This is really annoying because the appearance of underlying strength or weakness is nothing more than a false signal. For this reason, I like to use the volume oscillator with a price oscillator. One of the most important advantages when using a volume oscillator in conjunction with a price oscillator, such as stochastic or the RSI, is when a contradiction occurs between the volume oscillator and the price oscillator. Such contradictions are known as divergences or convergences between indicators. In this chart, you can see an example of a contradiction between the stochastic and the volume oscillator. The stock is building a platform, which is a common sideways pattern that develops as institutional investors move into a stock without moving price out of a tight range. Institutional investors are the most dominant of the market participant groups, and their activity often goes unnoticed because they use controlled bracketed orders that maintain price at certain levels. Stochastic oscillator is dropping below its overbought 80 line, while the volume oscillator is heading upward as the platform develops. This creates a divergence pattern between the stochastic and the volume oscillator. This pattern is a leading indication that the platform will break to the upside, which can be a critical piece of information for position and swing traders. In this example, the stock formed a platform during several months. Stochastic was overbought during this period, then slipped downward during the platform stage. However, the volume oscillator continued to rise during this period, followed by an upside breakout move. During moderately trending markets, when most price oscillators fail to oscillate but form a floating pattern at their overbought line, a volume oscillator can be an invaluable analysis tool for swing traders and position traders, exposing weakening price action before a retracement. This chart shows a spike on the volume oscillator during a platform and prior to the move up. This is an indication of heavy institutional investor activity that tend to use controlled bracketed orders that don't move price during the accumulation phase. As the stock moves up, the volume oscillator hovers around its center line, indicating steady, consistent volume activity, until the volume oscillator suddenly forms a divergence with price just prior to the topping price action. Platforms and bottoms often have huge up gaps due to institutional short-term and high-frequency traders who trade aggressively when they discover that their counterpart, the institutional investor, has been accumulating. Their large lot speculative buying patterns drive price up in sudden and explosive moves. The volume oscillator can be a useful tool in finding stocks poised for a huge gap. In this example, you can see an overbought stochastic as the volume oscillator turns upward and moves above its center line. Although price is sideways, volume is building energy during this bottoming phase. And here's the gap that formed shortly after. The volume oscillator indicated heavy buying activity prior to the huge gap. By using the volume oscillator with stochastic, swing and momentum traders are able to enter the stock prior to the gap price action, thereby increasing their profit significantly. That's why the volume oscillator can be an additional analysis tool to use with price oscillators to help expose strengthening or weakening volume patterns that often precede changes to price action and direction. As with all indicators, the volume oscillator requires study and practice to use it properly and learn its nuances. Extreme oscillation patterns can reveal shifts of sentiment and bias from buyers to sellers and from short sellers to buyers. The indicator is ideal for short-term trading styles and can show buying patterns of the institutional investor during platform markets when price action appears to be range-bound. However, the volume oscillator is an advanced indicator and should be used by traders who have some trading experience and a strong knowledge base of price oscillators and other indicators. Beginner traders, however, will need to first learn price oscillators and various volume indicators before attempting to use the volume oscillator. If you found value and learned something new, leave us a like to show your support, and make sure you subscribe and click the bell icon to stay notified when we release new videos. Until next time.